Welcome to The Deep Dive. We're the show that cuts through the noise, bringing you the insights you need. Today, we're tackling a question that, let's be honest, probably gives every investor that sinking feeling in their stomach. When stock prices just plummet, where does the money actually go? It feels like it vanishes, poof, like some kind of bad magic trick, but is it really gone? Or is something, I don't know, more nuanced going on? That's the mystery we're solving today.
It's a fantastic question, and honestly one that's full of common misconceptions. For those of us tracking the markets, getting this right isn't just academic, it's empowering. Our mission in this deep dive to really pull back the curtain on stock price drops. We want to move past that, that visceral fear and equip you with a clearer, more strategic grasp of what's truly happening behind those flashing red numbers. We'll deconstruct the dynamics, separate perception from reality, and hopefully give you the clarity to navigate volatility with genuine confidence.
And we've armed ourselves with some really excellent source material for this, so expect some surprising insights, and maybe more importantly, practical takeaways you can actually use in your own thinking.
Okay, let's unpack this then. When you log into your brokerage account, right, and you see that portfolio value shrink, that gut feeling is powerful. It really feels like cash has just evaporated, gone. But that illusion, persuasive as it is, it rarely reflects the underlying reality, does it? What's actually shifting?
You've hit on a really critical point there. Stock price movements. They're less about physical money moving around or vanishing, and much more about a collective and often very rapid change in the perception of value. Money doesn't just disappear into some black hole. Instead, the market's collective view, its assessment of a company's future earnings power or its stability. That's what's being repriced. It's a change in the consensus view of worth, not a literal draining of funds. Okay, so it's not like my loss is instantly someone else's gain. It's more like valuing a collectible, maybe. Say you buy a vintage comic for $150. Then news breaks, whoops, they found a huge stash of mint condition copies. Suddenly, the market might only value your copy at $100. The comic itself hasn't changed, right? Same art, same story. But the perceived scarcity, and so its market value, that shifted dramatically. That $50 isn't really gone anywhere specific. It's just a recalculation of what people are willing to pay now.
Exactly. That's precisely what we call a paper loss. It's theoretical. It's a decline in value on paper that only becomes a realized loss if you actually choose to sell at that lower price. Our sources really emphasizes this difference as they state stock price drops reflect changes in perceived value, not actual money disappearing. And crucially, market value losses aren't redistributed but represent a decrease in market capitalization. So no one else necessarily pockets that notional $50 you feel like you lost.
Right. So if the money isn't just evaporating, what is driving these sometimes huge shifts in perceived value? What's the core engine moving prices up and down?
At its heart, it still comes down to supply and demand. That's the bedrock. But for an informed audience like you, the deeper insight is understanding what shapes that supply and demand. It's not just the raw number of buyers versus sellers, it's the powerful currents underneath. Things like investor sentiment, future expectations, even, irrational fear or exuberance, that's what dictates their actions. When optimism is high, demand swamps supply, prices climb. When fear takes hold or negative news hits, sellers rush for the exits and prices fall. Simple as that, but driven by complex emotions.
And wow, have we seen that play out spectacularly? Just think about Tesla's incredible run from 2020 into 2021. The stock surged over 700%. And this was during a global pandemic. Investors weren't just buying shares. They were buying into a story, a powerful narrative, belief in Tesla's EV dominance, its expansion plans, Elon Musk's vision. By January 21, Tesla's market cap hit $800 billion. Which was amazing considering its actual vehicle production was still way below traditional automakers. That's just a perfect example of how potent future perception that narrative can be in driving demand.
A phenomenal case study, absolutely, in market psychology. Now let's look at the flip side. Remember Netflix in January 2022, they reported subscriber growth for Q4 21. It was just slightly below what was expected, 8.3 million new subs versus, I think, 8.5 million anticipated. On paper, a tiny miss.
Right? That is minor.
Exactly. But that tiny shortfall, combined with some growing worries about competition, it triggered a massive sell-off. The stock dropped 21.8% in one day, and it kept plunging, almost 70% down from its peak by April. The actual numbers were only marginally different, but the story the market told itself about Netflix's future growth, it flipped instantly, from bullish to deeply pessimistic.
And that rapid shift in narrative, from, exuberance to anxiety, that really shows how quickly investor sentiment can just rebalance supply and demand,
Yeah.
leading to these really intense price swings, even if the company's fundamentals haven't drastically changed overnight.
Okay, now this is where it gets really interesting, I think. Beyond those big forces of sentiment driving supply and demand, what are the specific triggers? What actually makes a company's stock, or sometimes the whole market, just take a nosedive?
It's a really delicate dance, isn't it? Between a company's actual results, its fundamentals, and the market's often fickle perceptions. Good news, or even just the anticipation of good news, that fuels demand. Easy enough. But negative news, or even just uncertainty, that can quickly trigger a flight to safety. Sellers suddenly outnumber buyers. Yeah, and one of the most immediate triggers has to be a big change in investor sentiment. Like when a stock dips, say Apple drops from $150 to $140, that $10 per share drop isn't just a number on a screen. It sparks a psychological reaction. For a lot of people, that initial dip triggers fear, that primal urge to cut losses, right? Which can lead straight to panic selling, and that creates this nasty negative feedback loop. We saw that with Netflix's rapid fall you mentioned. And the key thing here, sometimes the drop isn't even about bad news about the company itself. It might just be a broader reevaluation of risk, or maybe just herd mentality taking over.
Indeed. That's behavioral economics right there. Humans are hardwired for loss aversion. So the pain of seeing that paper loss can feel intensely real, and it often prompts irrational decisions. But, and this is crucial for the disciplined investor, these sentiment-driven drops can actually be opportunities. The savvy investor understands that a temporary mood swing in the market doesn't necessarily mean the company's its intrinsic value is permanently damaged. So these periods can become potential buying opportunities.
Okay, another really powerful trigger, poor financial performance. And this goes beyond just missing an earnings target by a few pennies. When a company's earnings or its profits or its revenue consistently underperforms what the market expects, that signals potentially deeper trouble, right? Maybe a weakening competitive edge, poor management, a shrinking market for its products.
Exactly.
The market doesn't just react to the past numbers, it projects them forward. It recalibrates all those future cash flow expectations we talked about.
And that ties right back to expectations. Stock prices are, in large part, a discount of future expected earnings. So a missed earnings target isn't just about the last quarter. It's about the market adjusting its view of the company's entire future trajectory. If investors collectively revise those expectations downwards, the price will drop. It has to.
Right. Okay, zooming out a bit now. We also see the huge impact of economic recessions. During a downturn, people spend less, businesses delay big investments, corporate revenues often shrink across the board. Investors, understandably, get risk-averse. They often rotate out of stocks and into safer harbors like government bonds. And this widespread selling, this capital flight, it just exacerbates the market's decline. It can become a self-fulfilling prophecy.
And closely connected to that is rising interest rates. When central banks hike rates, it makes borrowing more expensive for companies. That can squeeze profit margins, put a damper on expansion plans. For consumers, it means less disposable income, maybe higher mortgage payments.
Yeah.
But there's a subtler effect, too. Rising rates make fixed income investments, like bonds, look more attractive compared to stocks, especially growth stocks, whose valuations lean heavily on earnings far out in the future. Those get discounted more heavily when rates rise. So it creates this opportunity cost that pulls money away from equities.
And it's during times like those, especially, that the psychological pressure of seeing your wealth shrink really tests you. Sticking to your long-term plan, managing those emotions, that's often the hardest part, but maybe the most important for long-term success.
Absolutely. And beyond the economy, you have geopolitical tensions, wars, trade disputes, political instability. These aren't just headlines. They create real tangible risks.
Right.
Risks to global supply chains, energy prices, consumer confidence. Investors react to that uncertainty by selling off assets, fearing disruption, fearing volatility. They often pull capital from entire regions or sectors they see as exposed.
Then there's the more focused impact of major shareholder actions. When a big institutional investor, a pension fund, or a well-known fund manager decides to sell off a huge chunk of their holdings in a particular stock,
Right.
that can flood the market with supply, just overwhelming buyers. And it's not just the volume of shares hitting the market, it also sends a really powerful negative signal to other investors. Why are they selling? That can trigger a cascade of selling, sometimes amplified by algorithms reacting instantly.
And finally, let's not forget sector-specific problems. Not every downturn hits the whole market equally. Industries face unique headwinds. Think about disruptive technology making older business models obsolete. Blockbuster versus Netflix is the classic example.
Right.
Or maybe new regulations impacting an entire sector, like energy or pharmaceuticals. These kinds of challenges can cause really deep, targeted stock declines in specific industries, even if the broader market is doing okay.
So understanding all these different triggers, that's really key, isn't it? It helps you try to distinguish between just market noise, temporary fluctuations, and a genuine shift in a company's fundamental outlook. What looks like a universal market panic might actually be localized, or vice versa. Knowing that difference could turn a perceived crisis into, well, maybe an opportunity.
Let me just reiterate that core point. When a stock's price falls, it signals a decrease in its perceived value. It's a shift in what investors, collectively, believe that stock is worth at that moment. And that results in a lower market capitalization for the company. Critically, it's not usually about your loss directly becoming someone else's gain. The market as a whole has just reevaluated its assessment of that company's worth.
And these price declines, they don't happen in a vacuum. They send ripples through the whole financial system. For instance, a stock that keeps falling and falling can increase its sensitivity to market changes. It might become more volatile, maybe fall below thresholds that make it unattractive for big institutional funds. It can also make company financing more difficult if a company's stock price signals deep problems. It gets harder and more expensive for them to raise new capital, whether by issuing more stock or getting loans. That directly hits their ability to grow. Think about Ford back in 2020. They were facing grim sales forecasts. The stock was down. That made it much tougher to attract the investment needed for their big EV push.
Exactly. And while your immediate dividend check might not be affected by a price drop, if that drop signals underlying financial trouble, it can absolutely lead to adjustments to dividends and returns down the road. Companies might cut or even eliminate future dividend payments to conserve cash. That directly hits income investors. And for long-term growth investors, big declines can mean it takes much longer to reach their target returns. They might need to hold on longer just to get back to even.
Okay, so we've looked at individual stocks taking a hit, but what about when the entire market seems to dive? Is the stock market basically a zero-sum game? For every loser, there's a winner.
That's a really crucial distinction. And the answer is generally no, especially if you're looking at the long term. The stock market is primarily a mechanism for value creation. And sometimes, yes, value destruction. When a company innovates, grows its profits, expands, all shareholders benefit. It's like that saying, a rising tide lifts all boats. However, market crashes. They are powerful, stark examples of how value can be comprehensively destroyed across the system, without direct offsetting gains for others in the same way.
And history certainly gives us some dramatic examples. Take the 1929 crash, Black Monday and Black Tuesday, October 28th and 29th, drops of nearly 13% and 12% on consecutive days.
Unbelievable numbers.
And in just 3 months, from September peak to November low in 1929, the estimated value of the entire U.S. stock market basically halved. It went from $64 billion down to around $30 billion. That $34 billion just vanished. That's equivalent to over $626 billion in today's money.
And that wasn't just a correction. It was a catastrophic systemic failure, fueled by speculative bubbles, way too much borrowing leverage, and really a lack of effective regulation at the time. The plummeting stock prices didn't just hurt investors, they shattered confidence across the entire economy. That led to panic selling, bank runs. It triggered the Great Depression. By 1932, the Dow Jones had lost something like 89% of its value from the 1929 peak. Widespread business failures, mass unemployment, devastating.
Then fast forward to the 2008 financial crisis. That one started differently, right? With the housing market collapse and all the subprime mortgages going bad. But the Lehman Brothers bankruptcy in September 2008, that sent shockwaves everywhere.
The fallout was just immense. The S&P 500 plunged. Estimates suggest something like $17 trillion in household wealth evaporated, gone, due to falling stock prices and housing values combined. It led to massive unemployment, millions lost their homes, and it required unprecedented government bailouts and interventions, things like TARP and quantitative easing, just to stabilize the system. These events aren't just history lessons. They really demonstrate how, in these systemic crashes, value is truly destroyed on a massive scale. It doesn't just shift hands.
Okay, this brings us to a really practical point for everyone listening, especially when managing your own portfolio and maybe even thinking about taxes. It's the difference between a paper loss and a real loss. Sounds simple, but getting it wrong can be costly.
It's absolutely fundamental. Let's break it down. Unrealized losses or paper losses. That's when the market value of a stock you own goes down, but you haven't actually sold it. So say you bought 100 shares at $50 each. That's a $5,000 investment. If the price drops to $30, Your holding is now worth $3,000 on paper. That $2,000 difference, that's your unrealized loss. The key things: no immediate tax impact. You still own the shares. And crucially, the stock could recover. That paper loss could eventually turn back into a gain. Now, realized losses? That's different. That happens when you actually sell an asset for less than you paid for it. Using the same example, if you sell those 100 shares when the price is $30, you get $3,000 cash. That $2,000 difference from your original $5,000 investment is now a realized loss. This loss must be reported on your tax return. And strategically, it can be used to offset capital gains you might have elsewhere, or even reduce your overall taxable income up to certain limits. But once it's realized, there's no chance of recovery from that specific investment unless you decide to buy back later. The loss is locked in.
Right. And for active investors, that distinction is where strategies like tax loss harvesting come in, selling a losing position specifically to generate that realized loss to offset gains elsewhere, potentially lowering your tax bill. So understanding whether your loss is just on paper or actually realized, it's vital for making smart decisions about holding, selling, maybe rebalancing your portfolio. Now, okay, most of us invest hoping prices go up. Makes sense. But there's this other strategy, sometimes controversial, where some investors actually bet on prices going down. We're talking about short selling.
That's right. Short selling is, well, it's basically the reverse of traditional investing. An investor borrows shares of a stock, usually from a broker. Then they immediately sell those borrowed shares on the open market at the current price. Their goal, their bet, is that the stock price will fall. If it does, say from $50 down to $30, the short seller then buys back the same number of shares at that lower $30 price. They return the shares to the broker they borrowed from, and they pocket the difference, in this case, $20 per share, minus borrowing fees and commissions. The big catch, though, the critical risk for the short seller. Unlike buying a stock, where the most you can lose is your initial investment if the price goes to zero, a short seller's potential losses are theoretically unlimited. Because if the stock price goes up instead of down, say, to $100, $200 or more, they still have to buy it back eventually to return it, and their losses can just keep mounting.
So when you see heavy short selling activity in a stock, it can definitely put downward pressure on the price. It can amplify negative sentiment. And yeah, it often feels pretty predatory to long-term shareholders who believe in the company.
And that perception certainly exists. It gets a bad rap sometimes. But short selling also plays a vital, if often unappreciated, role in overall market efficiency. Short sellers often do really deep research to find potentially overvalued stocks or companies with maybe questionable accounting or weak fundamentals. By betting against them, they can help expose these issues sooner, which can actually prevent other investors from holding on to a bad investment for too long. It acts as a kind of market check. Plus, here's an interesting twist. Eventually, short sellers have to cover their positions. They have to buy back the shares. That buying activity itself can create upward momentum in the stock price, potentially leading to a recovery that benefits the long-term shareholders too. So it's complicated, not purely negative.
That really highlights another key point, doesn't it? Stock price declines don't always reflect a company's true underlying intrinsic value. Sometimes they're driven by short-term market noise, maybe amplified by speculative short selling or panic selling. Knowing the difference, or trying to figure out the difference between that noise and a real change in a company's long-term prospects, that's the challenge and the opportunity. Okay, so we've covered a lot of ground here. The dynamics, the triggers, the different kinds of losses. With all this complexity, what can you, the listener, the investor who now understands this better, actually do? How do you prepare for those inevitable market corrections or just dips in your own portfolio?
It really boils down to discipline, preparation, and having a strategic framework. First, and this loops back to behavioral economics, remain calm and revisit your investment thesis. Easier said than done, right? When loss aversion kicks in hard, the real insight isn't just telling yourself to be calm, but maybe pre-committing to a process, a checklist, something systematic that bypasses your immediate emotional reaction. Ask yourself, why did I invest in this company or this fund in the first place? Have the fundamental reasons changed? If the core reasons still hold true, then a price drop might actually be a buying opportunity, not a signal to jump ship. Building right on that is the buy and hold strategy. It sounds almost too simple, maybe even passive, but it's profoundly effective precisely because it's designed to counter our emotional impulses to trade too much, especially during volatility. It means riding out the market waves, trusting in the historical long-term upward trend of well-diversified markets. It requires real mental fortitude, maybe ignoring your portfolio daily, but historically it's been one of the most reliable paths to wealth creation and, of course, diversification.
This is Investing 101, but it's crucial. Spreading your investments across different asset classes, stocks, bonds, maybe real estate, commodities, and within stocks across different sectors, different geographies, different company sizes, large, mid, small cap. That's your primary defense against any single investment blowing up your portfolio. But here's a nuance. Understand that during extreme market stress, correlations can sometimes increase. Everything seems to fall together.
Right, that happened in '08.
Exactly. So true diversification might also involve looking at assets or strategies designed to have low or even negative correlation to the broader market, though that gets more complex.
And a quick practical tip here. For many people, broad market index funds like an S&P 500 tracker offer a really simple and effective way to get significant diversification without needing to pick individual stocks.
Absolutely. A cornerstone for many portfolios. Another key strategy. Keep strategic cash on hand. Think of cash not just as zero return, but as dry powder or optionality. Having some cash gives you immense flexibility. You can capitalize on opportunities when quality assets go on sale during corrections. It also acts as a crucial safety net, preventing you from being forced to sell your long-term investments at a loss just to cover unexpected expenses. And always, always maintain that separate emergency fund, typically 3 to 6 months of essential living expenses, kept safe in something like a high-yield savings account. That shields your investments from your personal life's bumps. Now, for investors comfortable with a bit more complexity, you can utilize advanced risk management techniques. This could mean using stop-loss orders, which automatically trigger a sale if a stock hits a certain price floor. Though, be aware they can backfire in very fast, volatile markets, sometimes locking in losses unnecessarily. Or it might involve option strategies. Buying put options, for example, can act like insurance against significant price declines in a stock or index you own.
These tools have their own costs and risks, but they can help manage downside or tail risk. And finally, consider investing in defensive stocks. These are typically companies in sectors like consumer staples, food, drinks, household goods, utilities, electricity, water, and healthcare. They tend to hold up better during economic downturns because people still need their products and services, regardless of the economy. They might not give you explosive growth in bull markets, but they can add stability and dampen the swings in your portfolio when things get rough.
All fantastic practical strategies. Definitely goes beyond just don't panic. Okay, let's zoom out one last time. We've talked a lot about market prices fluctuating, sometimes wildly. But what does that volatility really mean for a company's actual worth? Its fundamental value, separate from the daily market drama.
This is perhaps the most critical distinction for any serious long-term investor. It's understanding the difference between intrinsic value and market value. Intrinsic value, sometimes called fundamental value. That's an attempt to calculate an objective estimate of what a stock or a company is really worth. It's based on analyzing its fundamentals, its future expected cash flows, its growth prospects, the risks involved, its balance sheet health, management quality. All of it. It's generally more stable than the market price. Value investors calculate this using models like discounted cash flow analysis to try and determine if the current market price is too high, overvalued, or too low, undervalued, compared to this fundamental reality. Market value, on the other hand, that's simply the current price at which a stock is trading on the exchange. Right now, it represents what investors collectively are willing to pay for that stock at that specific moment in time. This value is highly volatile. It's driven purely by the hour-by-hour, day-by-day shifts in supply and demand, fueled by news, sentiment, speculation, everything we've discussed. And crucially, the market value may, and often does, diverge significantly from the company's estimated intrinsic worth, sometimes for long periods.
So the key difference is, intrinsic value is rooted in fundamental analysis, looking at the business itself and its future potential. Market value is about the current trading price, reflecting today's supply, demand, and sentiment. And it's that gap, that tension between the two, that creates opportunities for investors who can look past the daily noise and focus on the long-term fundamentals. Wow, what a deep dive this has been. It seems crystal clear now that when stock prices drop, money doesn't just evaporate into thin air. Not really. Instead, it's this really complex, dynamic interplay of perceived value, shifting investor sentiment, and real-world economic or company-specific events, all causing a fundamental reassessment of what the market thinks a stock is worth.
Exactly. And understanding these concepts, really internalizing them. From debunking the myth of disappearing money to grasping the crucial difference between unrealized and realized losses. And knowing the practical steps you can take to prepare for volatility, that's empowering. It helps shift your perspective away from reactive fear towards more proactive, informed, and hopefully calmer decision-making.
Absolutely. This deep dive has definitely armed you, our listeners, with some powerful insights. And hopefully a much clearer, maybe even calmer perspective on what's really going on when those numbers on your screen start flashing red.
And maybe a final thought to leave you with. Considering just how rapidly investor sentiment can shift, sometimes based on what seems like pretty minor news, and given that stark difference we just discussed between a company's underlying intrinsic value and its often wildly fluctuating market price, what truly defines a good investment for your long term? And perhaps more importantly, how do you build the conviction, the discipline, to stick with that belief when the market itself seems to be screaming that you're wrong?
A fantastic, thought-provoking question indeed, something to really mull over. Thank you for joining us on this deep dive. Keep exploring, keep learning, and definitely keep asking those important questions.